Essay 299, Joint Audit of Financial Statements. What is a joint audit? A joint audit involves the appointment of two or more auditors to conduct an audit together and issue a common audit report. It is common in large entities, public sector undertakings, or where audit scope is vast and complex. Q1. Responsibility and coordination among joint auditors. 1. Individual responsibility. Each joint auditor is responsible solely for the work allocated to them. Duties include planning and performing audit procedures, evaluating risks and internal controls, gathering sufficient and appropriate audit evidence. Example, Auditor A is assigned revenue, Auditor B is assigned fixed assets. Each is individually accountable for their area. 2. Joint and several responsibility. Joint auditors share joint and several responsibility in the following scenarios. Area, description, undivided audit work. Any part of the audit not specifically divided is the responsibility of all joint auditors. Common decisions. All are responsible for key decisions on common matters like audit strategy, materiality levels, etc. Matters brought to notice. If one auditor informs others of a critical matter and there is consensus, all are responsible. Compliance with statutes and ensuring the financial statements comply with laws and accounting frameworks. Disclosures and audit report. Joint responsibility for ensuring appropriate disclosures and that the audit report follows statutory requirements, essays, and ICAI pronouncements. 3. Inter-auditor communication. If an auditor encounters a matter relating to another auditor's area that needs attention, they must communicate in writing to the relevant joint auditor. 4. Responsibility for audit planning and execution. Each auditor must determine nature, timing, and extent (NTE) of procedures for their area. Risk assessment and internal control evaluation must be done individually. However, decisions regarding NTE in common areas are made jointly. Q2. Reporting by joint auditors. 1. Normal scenario. A common audit report is issued by all joint auditors with unified opinion. 2. Disagreement among auditors. If one auditor disagrees with any aspect, a separate audit report is issued by that auditor with reasons for disagreement. 3. Cross-referencing reports. Main audit report must refer to the separate report issued. The separate report must cross-reference the main audit report. Refer to SA 706 for format of emphasis of matter, EOM, and other matter paragraphs. Q3. Developing a joint audit plan. Joint auditors must identify and divide audit areas and highlight common areas. Define reporting objectives. Communicate significant factors influencing audit direction. Consider results of preliminary engagement activities and past audits. Assess and plan for resources and timing. Q4. Other key considerations. 1. Assumption of compliance. One joint auditor may assume the other has performed their work as per essays, brought any departures from AFRF to their notice. 2. Discussion before finalization. Joint auditors must discuss audit conclusions, resolve any differences before signing the report. 3. Common documentation. Common engagement letter, common management representation letter. 4. Work allocation. Division of work is done via mutual discussion. The work allocation document, signed by all auditors, communicated to those charged with governance, TWG. 5. Inclusion of EOM/OM or modification. If any auditor intends to include a modification or EOM/OM paragraph, they must inform TCWG about the reasons and wording. 6. Documentation requirements. Must document division of work, NTE of procedures, basis of conclusions. Branched division audits. If one auditor audits a branch, others may rely on the FS prepared, assuming they present a true and fair view and comply with AFRF. Case scenarios for practical understanding. Case scenario 1. Work allocation and responsibility. ABC Ltd. Appoints Auditor A and Auditor B as joint auditors. Auditor A is assigned the audit of sales and debtors, while Auditor B is assigned purchases and creditors. During the audit, a significant fraud is found in creditors. Shareholders later raise concerns. Who is responsible? Only Auditor B, as the area was assigned to them. Auditor A is not responsible unless the issue was brought to their attention. Case Scenario 2, Undivided Responsibility. In a bank audit, neither Auditor A nor Auditor B is assigned the verification of cash in hand at branches. Later, a misappropriation of cash is discovered. Who is responsible? Both auditors are jointly and severally responsible since the area was undivided. Case Scenario 3, Disagreement in Opinion. During the audit of XYZ Lilted, Auditor A is not satisfied with the valuation method of inventory, impacting going concern, but Auditor B believes it is appropriate. What happens? Auditor A issues a separate audit report with a qualified opinion. Auditor B issues an unmodified report but includes a reference to Auditor A's report under SA 706.